It begins in 1971, with a sound almost no one noticed: the quiet click of a pen in Richard Nixon's hand. On August 15th, the President of the United States appeared on television to announce something that would change the global economy forever. His tone was calm, but his words were explosive. The U.S. would no longer convert dollars into gold. The promise that had anchored the world's financial system since World War II was gone. The dollar was no longer as good as gold. At first, the world barely reacted. People still traded, factories still ran. But beneath the surface, the foundation of modern finance had cracked. For the first time in history, money was no longer tied to anything real. To understand that moment, we have to go back to 1944, to a quiet mountain resort in Bretton Woods, New Hampshire. The Second World War was still raging, but the Allies were already thinking about the peace that would follow. 700 delegates from 44 nations gathered to design a new global system, one that would avoid the chaos of the Great Depression and the currency wars that helped fuel fascism. Their solution was bold: tie the world's money to gold through one stable currency, the US dollar. The United States, rich in gold and industry, became the anchor. Each nation would fix its currency to the dollar, and the dollar itself would be convertible into gold at $35 an ounce. This new system, managed through the International Monetary Fund and the World Bank, aimed to combine the best of both worlds: the discipline of gold and the flexibility of national policy. For nearly 30 years, it worked. Europe rebuilt, Japan rose, and the global economy entered a golden age. Exchange rates were stable, inflation low, and trade flourished. The dollar was trusted everywhere. It was, quite literally, as good as gold. But the very success of Bretton Woods carried the seed of its collapse. As trade expanded, the world needed more dollars to function. The United States supplied them by running deficits, printing dollars that were not fully backed by gold. The system depended on trust, and trust depended on restraint. But restraint is difficult for empires. The economist Robert Triffin warned that the system was doomed by contradiction. The world needed US dollars for liquidity, yet the more the US printed, the less faith others would have in them. It became known as the Triffin dilemma. By the 1960s, the cracks widened. The U.S. was fighting an expensive war in Vietnam while funding vast domestic programs. The government spent far more than it earned, and inflation quietly spread. Dollars piled up in foreign central banks, and questions grew louder. Could America really redeem all those dollars for gold? French President Charles de Gaulle didn't think so. In a dramatic act of defiance, he sent the French Navy to New York to collect gold in exchange for dollars, a gesture that symbolized collapsing confidence. At home, the political cost of admitting weakness was too high. Instead of tightening spending or raising taxes, Washington printed more money. By 1971, there were over 3 times as many dollars in circulation as gold reserves in Fort Knox. When foreign governments demanded gold, Nixon's administration realized the U.S. could no longer honor its promise. And so, on that August evening, Nixon closed the gold window. The dollar's tie to gold, and the entire Bretton Woods system, was dead. The consequences were immediate and far-reaching. Currencies began to float freely, their value determined by markets rather than by governments. Exchange rates fluctuated wildly, inflation surged, and economic uncertainty swept across the world. But in this chaos, a new system quietly emerged, one not backed by gold, but by confidence and debt. The US dollar remained the dominant currency, not because of its convertibility, but because there was no alternative. Oil, trade, and global finance all depended on dollars. The dollar had lost its anchor, but gained the world. Freed from gold, the U.S. could print and borrow without limits, and it did. The post-1971 era saw the birth of modern finance, credit cards, global debt markets, and computer-driven trading. Money became elastic, expanding with every loan, bond, and investment product. Growth seemed infinite, but without the discipline of gold, there was also no natural break. Debt replaced gold as the world's foundation. Governments borrowed to spend, companies borrowed to expand, and citizens borrowed to consume. In the 1980s, under Reagan and Thatcher, deregulation accelerated. Finance became the new frontier of power. The dollar reigned supreme, oil was priced in it, and the United States could now export inflation by exporting its currency. The world's dependence on the dollar and on American debt deepened. But the old contradiction lingered. The U.S. had become both the world's banker and its biggest debtor. Confidence replaced gold, but confidence is fragile. Then came 2008, the logical end of the post-Bretton Woods experiment. The global financial crisis was not just about housing or speculation. It was a system built on faith meeting its limit. When banks lost trust in each other, the world froze. For a brief moment, the dollar itself wavered, not because of a lack of metal, but because of a lack of belief. The system survived only because governments intervened, printing more money than ever before. The gold standard was gone, but the ghost of Bretton Woods remained. Once again, the world was saved by paper promises. Looking back, it's easy to see Bretton Woods as a failure, but for nearly 3 decades, it delivered stability, growth, and cooperation on a scale the world had never known. It rebuilt Europe, revived Japan, and shaped the institutions that still define our economy: the IMF, the World Bank, and the dollar's global dominance. Its collapse didn't end the story. It began a new one: the age of fiat money, floating exchange rates, and debt-driven growth. Yet every system carries the seeds of its undoing. The dollar's supremacy today rests on the same fragile foundation as before: faith. The U.S. can print money to solve crises, but each time it does, the promise weakens. Nations diversify their reserves, digital currencies emerge, and trust, the invisible glue of the system, thins a little more. What happens when the world begins to doubt the dollar the way it once doubted gold? 3 lessons remain. First, money is not metal, it's belief. When belief breaks, systems fall. Second, power built on debt can last for decades, but never forever. And third, no nation, however mighty, can defy arithmetic. You can delay consequences, but not erase them. The Bretton Woods system built modern finance, and its collapse revealed its true nature. Every dollar in circulation today carries the echo of that New Hampshire conference and the click of Nixon's pen in 1971. The world learned that money's strength doesn't come from gold in vaults, but from the world's faith in the hand that prints it. If this story made you think differently about the dollars in your pocket, subscribe to Economic Collapse. Because every empire, every economy, and every currency eventually faces the same question: how long can trust last when it's no longer backed by anything real?